Most traders lose money trading indices because they treat them like stocks. But indices behave differently. Today, I'll show you how professionals break down indices like NASDAQ, S&P 500, US30, DAX, Gear 40, etc. And by the end of this video, you'll know how to analyze indices step by step so that you can trade smarter, not harder. You want to make sure that you stick around till the end because I'll share a professional level checklist that you can use before every index trade. Step 1. You need to always look at your trading charts from the bigger picture.
The bigger picture starts from the monthly time frame if you are a swing trader and goes all the way to the daily time frame for day traders, passing it down to 1 hour 30 minutes for scalpers.
Professionals don't jump into 15 minutes or 5 minutes charts. They zoom out because they want to make sure that they are taking trades that they know and understand. Once you've got the bigger picture, it's time to mark out the key levels. Pros mark zones, not just random lines.
If you are a day trader, your bigger time frame will be a daily or 4 hour. And this is a US 500 chart. The first and most important thing you do when you get into your trading charts is to figure out the trend direction, because the golden trading rule is always trade with the moving trend. It is very important to know where the market is going so that you can trade accordingly. Many traders use trend lines to determine trend direction even as part of their strategies to execute trades. I personally don't use trend lines for indices, but when it comes to indices, I'd advise that you stop using trend lines because you will get so many false signals and you will most of the time lose trades. Go ahead and watch these 2 videos to see how this plays out. But in a nutshell, as you can see clearly from this structure right now, that the trend line rule was broken, and after it was broken, it was not respected. And if you think that maybe it's because you didn't place your trend line correctly, maybe you were supposed to place it here like this, as you can see for yourself that the trend line rule was broken. Even the candlesticks rejected the trend line, meaning that they confirmed that this structure is going all the way down from here. But did it go all the way down from here even after such multiple rejections in the higher time frame? No, the trend line rule was not respected at all. Again, it was violated. So indices violate trend line rules, and if you trade according to trend lines or use trend lines for confirmations or whatsoever, you may need to stop because you are far from winning consistently. Sometimes they will respect, but most of the time they won't. And again, to learn more about that, watch my 2 previous videos. By the way, if you are wondering which broker am I using to analyze this chart, the link for this broker will be linked in the description box. It's literally like the best I have used so far in my entire trading journey. Even quick withdrawals, like your money gets to you in a couple of hours. Fast executions as well.
Secondly, you need to look out for your previous highs or lows because those are your psychological levels.
In an uptrend, the market moves in an upside direction, creating higher highs and higher lows. As you can clearly see, that is what is exactly going on this chart. If the market breaks the previous high, this represents the continuation of the trend, further telling you that you can continue looking for buying opportunities. But if the market fails to take out the previous high in an uptrend, it may mean that the market is overbought and may potentially change character. Or there's currently an existing liquidity that the market is interested to, and after taking it out, it may then continue with its prevailing trend, especially since these are indices. That is done a lot here.
Also take note on the round numbers, especially on S&P 500. Those are huge magnet zones. Institutions always leave footprints behind. If you can learn to read them, you can master following their moves. Step 4. This is where 90% of traders mess up. They overload charts with indicators hoping that they will make money faster this way, while pros keep it clean. Step 5. Analysis is useless if you can't time entries. Drop to low time frames, 1 hour or 15 minutes only, and look for confirmation candlesticks. It may be rejection signals or engulfing candlesticks. Next up, you need to make sure that your risk management is on point. You don't want to lose more than 1 or 2% of your entire trading account. And you want to make sure, most importantly, you want to make sure that your trade has the most beautiful risk to reward ratio. Now, let's recap. Here's the professional index analysis checklist. Number 1, start with the bigger picture. Number 2, mark out your supply and demand zones or your key levels. Number 3, watch institutional clues. This may be volume, VIX, or colorations. Number 4, keep technicals simple. Number 5, drop down to lower time frames for entries and make sure that you have strict risk management. If you are part of our free trading community group, this checklist will be sent to you directly as the comfort of your home through our trading group. If you are not yet part of our trading group, go ahead and check out the description box. There are useful resources there that you can catch to maximize your profit trading indices. If you apply this checklist, you'll stop trading indices like a gambler and start trading like a professional. And now it's your turn. Comment down below which index you are focusing on, and I'll reply with my personal analysis for that particular index. Make sure that your bell notification is turned on so that you don't miss out on my future uploads. May the peace of God rule in your heart. I'll see you on the next video.